Bismillahirrahmanirrahim. Assalamu alaikum. Welcome to Mastering Accounting Skills. Today our topic is accounting for dividends, owners' drawings and owners' salary. These are actually three types of payments that a business makes to its owners or shareholders against either the profits or the equity they have invested in the business. Each of these payments has separate accounting treatment. Now one by one we will explain each of these payments and also we will see their accounting treatment. First of all, we will see dividend and its accounting treatment. What is dividend? A dividend is actually a portion of profit or retained earnings that a company distributes to its shareholders. Each shareholder will receive a dividend according to the ownership percentage in the company. The amount of the proposed dividend can change every year depending upon the decision taken by the board of directors in annual meeting. However, maximum limit of the dividends is up to the retained earnings balance. Important thing to note down is that dividends are not an expense. You cannot record it as an expense and deduct it from your profit in the income statement. In the chart of account, once the dividend is proposed, it is shown as a liability of the company. Now we will go through a small illustration. Here we will see that how the dividends are proposed and how this amount will be distributed among the partners, and how we will calculate each partner's share in the dividend, and also the accounting entry to record this transaction. So here in front of us, as you can see, we have total equity 1,050,000. It is the total amount what all the partners have invested in the company. Then we have retained earnings, opening balance, then profit during the year, 126,500. After that we have the closing balance of retained earnings, that is the opening balance plus the profit for the year during the year 2017. The proposed dividend amount is at the end of each year. When the accounts are finalized, the board of directors, they will have a meeting probably by the Jan end or in the February, so whatever will be the date. In the meeting they will decide that out of this profit of 202,000, how much each partner how much amount they can announce as a proposed dividend. Suppose after the in the meeting, all the board of directors, they have finalized a figure of 100,000. Out of this 202,000 profit retained earnings balance, that we will distribute this amount this year to the shareholders. So now they have finalized the amount, so we will see that how we can divide it among all the partners in the business. So here we have the detail of this 1,050,000 equity, that each partner how much he invested. Like James, he has 450,000, Michael has 360,000, and Martin, he has 240,000. Here is their equity percentage calculated. 43% his share, and Michael's share is 34%, and Martin has 23%. So now we will calculate each of partner share in the this 100,000 proposed dividend. So how we will calculate this amount? Make add $sign to fix this cell, multiply by this his percentage share in the company. Okay, drag this formula till end. So like this, we will calculate each partner's share in this 100,000 proposed dividend amount. So James will get 42,857, Michael will get 34,286, and Martin will 22,857. So this is the amount each partner will get. Now we will see what how we will record this transaction. So to record this transaction, there will be two transactions. Okay, The one entry we will make to record the liability. Then what we will do, 100,000, it will decrease the retained earning balance, so we will give debit to retained earnings, and then credit will be dividend payable to James is this one. Similarly for Michael and Martin, remove the decimals. So this entry we will pass to record the liability for the proposed dividend. That 100,000 we need to pay, and to who, how much, this we recorded here. Then we at the time of payment, when you are going to make payment, so liability dividend payable, this is your liability account, you will give it debit, okay, with this amount. And then here you will give credit to your bank account, okay, with 100,000. So this entry we will make for one entry to record the liability and the second entry to record the payment. Now just take a moment and review what we have discussed regarding dividends. The next thing we are going to discuss is owner's drawings and its accounting treatment. Drawings is simply a method of taking out money from a business by its owners. Owner's drawings is commonly used term for small businesses, while dividends are usually associated with listed or large companies. Either you use drawings or dividends, at the end of the day, both of them will reduce owners' equity. Owners can withdraw money from their business at any time. In case of partnership, owners can withdraw money with mutual consent of all other partners to make it transparent and undisputed. Then the important thing to note down, that drawings is not an expense or income statement item, same like dividends. It is treated as a contra equity account and presented in the balance sheet as a deduction from the equity. In case of drawings, there is no limit. An owner can withdraw any amount up to his equity share. Now we will see what will be the accounting entry to record this transaction, owner's drawings. So whenever an owner is taking out money, like suppose he is taking out $10,000, so you will give debit to drawings account and credit will be to the bank account with the same amount. So during all the accounting period, you will make all the entries for the accounting for the owner's drawings, and whatever total drawings an owner has withdraw from the business, this will be deducted from his equity share in the balance sheet. Means the total equity minus the drawings, so it will reflect the net balance of the equity in your balance sheet. So it will be the accounting treatment for the owner's drawings. So it's very simple. Now just take a moment and review what we have discussed regarding drawings and its accounting treatment. last slide we will see owner's salary and its accounting treatment. An alternative approach for business owners is to pay themselves with salary. When a business pays salary to its owners, it does not reduce directly the owner's equity. Owner's salary is recorded as a monthly expense and it reduces the taxable profits. Then owner's salary should match. There is a limit. It is not like proposed dividends has a limit up to the amount of the proposed dividend, but for the drawings there is a limit up to the equity of the partners. But for the salaries also it is not limitless. Owner's salary should match with the skill set, and also it should be market competitive. It is not allowed by the tax authorities to record unreasonably big amounts as owner's salary just to reduce the taxable profits. Then what will be the accounting entry to record the owner's salary? It will be salaries, expense, will be debit, and accrued salaries will be credit. Okay, then at the time of payment you will give debit to accrued salary and credit to the bank or cash. Okay, here we have supposed the salary amount of same like 10,000. So this will be the accounting entries to record owner's salary. Same like employee salary, it will be recorded. Now just take a moment and review what important things we have discussed regarding. I hope we are clear on the topic, and I hope that the knowledge we have discussed in this video will add value to your professional skills. Thank you for watching this video. Stay connected. Thank you.